Good evening and good afternoon, everyone. This is Financial Literacy One-on-One. And today I have a special guest. His name is Stephen Gardner. And just a little bit background information about Stephen. He's a best-selling financial author with 7 books in total. One of his most popular books is Taming Wall Street. Over the past 3 or 4 days, I've been reading it, and it's actually been a lot of great and good information to help really fuel your financial engine of information that I didn't even know. I heard of it, but I really didn't know too much about it. Now, Stephen has been in the safe money planning space since 2003. He lives in Utah with his wife and 3 kids, and he is on a mission to help strengthen Americans one family at a time. Welcome to the show, Stephen.
Thank you, Ray. Thank you for having me.
Now, as you know, we talked about Taming Wall Street. What does that book really entail?
So, well, it entails a few things. Back in 2007 and 8, I lost 40% of my 401k, like
40%.
Like many people. Yeah. The Great Recession hit. It was bad news for a lot of people. And at that time, I was thinking, okay, I have background in insurance. I've done retirement planning, but now that I've taken this big loss, I never want to hurt like that again. It set me on this journey, and I started just going, okay, where are the rich really saving their money?
Yes.
And I learned, they have quite a bit in the stock market. I learned that they have quite a bit in real estate. Most of them
Very
have
diversified.
Yes, they've made their money in businesses. But what I was shocked from the Wall Street Journal was to learn just how many of them have their money in what's called permanent insurance or cash value insurance.
Permanent insurance or cash value insurance. Okay.
Yeah, so it allows you to take out an insurance policy on your life, and a large part of that, the way that I build it, is just like a bank account. It's just a big pile of cash that as you add more in, more and more builds, it starts to get compound interest every single year, and you're not taxed on that. But then what's neat about it that I share in Taming Wall Street is this ability to control your own money. And you can actually borrow that money out and go do other investments, or you can just simply own your own debt. And that message has really appealed to people because if you think about your monthly bills, how much of most people's money is going to debt? Credit card payments, car payments,
all of it.
house pay. Yeah. And so at the end of the day, it's like, wait a minute, am I working for myself, or am I working for my mortgage company and my bank and my car and insurance? And so this allows you to create your own financial system that you build that's going to earn 5 to 6% every single year. It's never not earned. That's what's kind of cool, even during major crashes. But it's going to allow you to build this pool of tax-free money that you can then go use in the real world on investments or debt purchases that you can control.
Now, even though this is tax-free money, there is an interest rate that's associated with it, correct?
Yes. So the way that your money continues to earn interest as if it were never gone is because you're actually using the insurance company's money. So they're going to collateralize your pool of money. That way they know that you're not going to stiff them on a loan or not pay back, or if you die, that you're going to be able to circumvent the repayment. They've thought of all of that.
Okay.
But they're going to lend you the money, and you're going to be able to go put that to work. So if you're doing like an investment, then you need to be earning higher than what the insurance company is going to charge you, or it doesn't make sense. If you're owning your own debt, then you just need to pay it back like you normally would. But you end up paying loans off faster through the insurance company than you do a traditional bank.
Okay. But now that interest rate, now essentially we're borrowing from ourselves and paying back ourselves, even though the insurance companies are keeping the amount that we originally had in there, and they're using that as collateral to loan us the other portion. Now that interest rate, though, that interest amount rather, are they getting paid that for their services, so to speak, or is that going back into your account as well?
So it does go back to the insurance company, but the insurance company that I use, if they are profitable, then they issue a dividend. And because you're an owner of the company, then you get a dividend on top of your guaranteed interest increase. So
Mm,
it's kind of like paying the company that if they do well, you do well.
I understand.
Yeah. So
Similar to investing, it almost sounds like when you are a stakeholder in a company and they do well because your investment, they pay you back dividends.
exactly. Yeah. So let's say somebody worked for um, Amazon. Let's just use Amazon as an
Okay,
example. If you had shares in Amazon, it would make sense to buy from Amazon because ultimately you're increasing the value of the company you have ownership in, right?
exactly.
So same thing here. They're going to put your premium dollars to work so that when you die, they have the money to pay out your beneficiary. But if you end up borrowing it, then they just created a guaranteed stream of very low risk money to the company, but it comes back. But as the company as a whole does well, they issue a dividend, and that just makes your plan grow a little bit better. So it's kind of a nice way. Now there are stock companies out there that the money just goes right to the insurance company. But what's called a mutual company means that everybody that is an owner of a policy is an owner of the company.
Huh.
Yeah.
Well, let me ask you this. How did you come across this particular, saving slash investing, a way to safeguard your money in a tax-free account and then use your own money without paying a large portion back to a bank? Like, how did you first come involved in that? And do you do it as well?
Yeah, I practice what I preach.
Okay.
Absolutely. I own 3 of these plans. I have for over a decade now. So I've built up enough capital in my plan that I can actually deploy it on real estate and cars and other investments. But after I took a 40% loss in my
40% loss. Can I
401k,
can I put that in perspective for the viewers?
yeah.
So basically what Stephen is saying is if he had $100,000 in his stock portfolio, his financial portfolio, um, during the recession of 2008, 2009, he lost 40%. So essentially they took away 40,000. He only had 60,000 left. So that's just put into a wide perspective. Go ahead, Stephen.
Yeah, I appreciate that. And, that's the kind of loss that it sticks with you. And so I started researching what wealthy people were doing as far as real estate, how much of their portfolio was in stock. And what shocked me was how much of them are growing money inside of these cash value insurance plans. And the main 2 reasons are, and this kind of goes with what Benjamin Franklin says, right? The only 2 guarantees in life are death and taxes.
Taxes, yeah.
This takes care of both of those. So if I don't have 30 years to build up a retirement for my wife and I die, this immediately creates a large lump sum of money that can never be taxed. But if I do end up building that, then I have a big pool of money that can never be taxed that I can use during my lifetime. And then when I die, the difference will be paid out to my family. So once I started to understand that protection of my life and my earned income over the course of my life, and then not paying taxes, I was like, okay, wow, this is really neat. But then the big aha moment came for me. I was at a Nelson Nash conference. This was in, oh gosh, this was probably 12 years ago or something like that.
Okay.
But he showed examples of how to own your own car payment. Instead of going to the bank and losing money to interest and depreciation, is to take that money out of your pocket and stick it in your other pocket. And when he showed that, all of a sudden I was like, okay, wait a minute. Uh, I started doing a little bit of research and I
How's this
realized,
legal?
yeah, well, the main thing was I read that the average American will spend over $250,000 on cars in their lifetime.
That's true.
So if you buy 10 $25,000 cars between age 25 and 85, that's 60 years of buying cars It may be more than that now.
That's
Again,
true.
this was
Yeah.
12 years ago. If you could flow all of that money back to your own family, you're going to end up having significantly more wealth than most people. Right now, the average baby boomer is trying to retire with less than $50,000.
Yeah,
And
I
so,
also read that in your book. I think that's one of the first in one of the first chapters I read. But here's another thing. Now, is this just an ingredient or a different tool? But this is not to be confused with something I could pay myself in my retirement, because I have to essentially, any money that I've taken out of that insurance account, I have to pay back. I can't use it as a 401k, or IRA. This is not to be confused with that. Or am I off a little bit?
uh, so it is a little bit different, but by the time you get to retirement age, we don't put any more contributions. So with a traditional
Ah,
plan, you are forced to pay in until you turn age 100. With the way that I build them, we can turn them off after 10 years. Most people will pay until age 65 or 70.
okay.
But at that point, we want our bills to go down, right? We want our house paid off. We want to,
Yes.
so let's say that someone at that point has built up $1 million, right?
Yes.
At that point, you could probably take $50,000 off for the rest of your life and never run out of money.
Mm.
You're basically living off of the interest,
But
and then
you can take money out of it and you don't have to pay it back.
you don't ever have to pay it back.
But
Um,
is at a certain age though?
no, I mean, like I could borrow money right now and never pay it back. The difference is I won't be able to borrow against that in the future because I didn't pay it back, right?
But what if you still had money in there? They essentially don't take the money from that amount, do they? Or
I'll give you an example, right? So let's say I have $10,000 and I borrow out 2,000.
okay.
I still have the 10,000, but according to the insurance company, I only have 8,000 of collateral left.
Yes.
Okay, so I still earn on the full 10,000. I'm going to pay a little bit of interest on the 2,000 until I pay it back, but the 10,000 is going to continue to earn interest as if the money were never gone. Now I
Okay.
never have to pay that back, and I'll keep earning, but I'm going to be short 2,000 of collateral in the future if I don't pay it back.
Ah,
Okay.
so you don't have to pay it back, but it's advantageous to pay it back, because
Yes.
as that money was accumulating, they're going to take their $2,000. The question is, if I don't pay it back, will it be compounding interest being added to it once they do take that $2,000 back?
Uh, well, it's been compounding on your behalf the whole time, but they are also charging you interest. Okay.
Ooh.
So, for example, if you're being charged that 5% interest, right? Then you owe yourself 2,000, but you owe the insurance company $100 for the year,
Okay.
right? So
Okay.
it's not a huge amount, right? So you would need to pay that back, but your 10,000 just increased by $500. So you can do one of two things. You can pay that interest on your anniversary date, or what I do is I just tell them to capitalize it, which basically means just eat it internally, and they'll just eat it out of your growth, right? The only reason that
So you don't pay anything back. You just have them to eat it inside the account, and then you just keep adding.
no,
So now you're not making double payments.
I always pay my loan back.
Oh, okay.
And
Okay.
I'm still making my premium payment as my savings program, right? So
But
for example, go ahead.
never mind.
Okay.
I answered it already in here, because I was
Okay.
about to say, well, it's almost like you're double paying, but I like it would be the same difference if you had this account and you went out to a bank, get
Yeah.
a loan. It's the same
If
thing.
whether I'm saving $500 a month for myself and I get a car, I still want to save 500 for myself, but I have to pay the bank. In this case, I'm saving for retirement. I'm also paying myself back on the car loan, right?
Okay.
So,
So
and the insurance company is never going to call you. They're never going to knock on your door. They're never going to send you threatening letters. If you never pay it back, it's no skin off their nose. They just charge you a little bit of interest, but it's your money, right? So I
yeah.
tell people, you want to be a good banker and you want to pay that back, because in the future, you're going to want to borrow again, right? So like, for example, let's say I borrow $20,000 to go buy a car, and then I figure out whatever the payment plan is. I send that back to myself because in 5 years I'm going to want to sell that and get a new car. And now I've recovered all the money over here so that I have it to borrow on the next car.
Now, what is the usual savings rate, interest rate for the plan itself? And then what is the usual interest rate when you borrow money from yourself?
So right now, for close to 100 years, they've been paying between 5 and 6%.
Okay.
Okay. So, and the interest rate has been for the last 10 or so years has been 5%.
Okay.
So, which is a little bit higher than what a bank is charging right now,
Sure.
but it ends up with it's kind of hard to explain on a video without having like a drawing board.
You got
But
one behind you. No, I'm just
well, if it wasn't blurry, I just did a video last night about someone who borrowed $15,000 to be their own source of capital on a car purchase. So that's on my channel right now. But
and what is your how do I look for your channel?
If people just search Stephen Gardner, they'll find me. I have over 100 videos. Yeah, so they'll find me, and it'll be this face, unfortunately. But it is what it is. It's what God gave me. But anyway, my wife and I, we've used it to do like right now we're doing her minivan.
Okay.
Yes, I own a minivan. I'm not ashamed to admit it.
Do you have the soccer stickers on it too?
No soccer stickers.
Okay.
We don't have any kids that play soccer, just dancing and swimming.
Okay.
But so with that, her payment to the bank was going to be $373, right?
Yes.
So we just borrowed the money out. We still make a savings payment to that, but then we pay that back, right? And then 5 years from now, when she wants the latest and greatest minivan, I have the money to go buy the next van. Plus, I'm up, right?
True. And I'm also thinking, not to cut you off, Stephen, but I was also thinking, what if I don't have the money that month to pay to myself back to an insurance company? I'm not going to be dinged, am I?
No, that's the beauty of this. Is let's say. Let's say that you borrow $20,000. Your payment that you set up to yourself is $400, right?
Okay.
Two things. Number one, you pay that back in, right? When you take $400 out of your pocket and you hand it to Wells Fargo, right? Do you ever get to see or use that money again?
Where's that? That money's gone. It goes into a black hole.
The bank took it. They built another building, right?
Yeah.
With the insurance company, within 21 days, you have full access to 100% of that money again if you needed it, right?
Wow.
Kind of like a HELOC. You make a payment, that money becomes liquid again, right?
Yep.
Same thing here, except for that you're the HELOC, okay? The other thing is, if I need to skip a payment, why is the insurance company going to report to my credit, hound me, threaten to repo my car? It's my car and my money. It would be inappropriate for them to communicate anything to you because it's your money, right?
So they don't report anything if I miss a payment.
They don't report anything, right?
But essentially, you're going to get, interest being taken away from you because of the agreement that you came into. But there's no financial hardship as far as pressure to paying it back. If you had a bad month, a bad 2 months, you can keep paying your insurance plan. And as you would do, you tell them to eat it. You can do that as well.
Yeah, I'll be honest. Probably 9 years ago, let's see, this would have been 2012. So about 8 years ago, I stepped away to help my father-in-law build a business similar to Groupon. Some bad decisions were made by the board. It ended up falling apart. During that time, I called the insurance company. I told them, listen, I can't make a payment. And they're like, okay, that's fine. You've got enough equity that if by next April you don't make a payment, we'll just cover your cost of insurance out of your equity. Perfect. Well, within a few months, I was back to work. And so then I just turned back my payments on and started making that. It really is up to, they don't bother you about your money. But it's just such a great place to hold money. And, a lot of us, we've been forced into the stock market or to take more risk than we want because banks are paying like a tenth of a percent.
Definitely.
And we've forgotten what even just 5%, like I showed a guy and he goes, these numbers are made up. And I go, no, it's because you're used to earning a tenth of a percent at America First Credit Union. So, but what I showed him, I don't know if you'll be able to see this.
No, I can definitely see it.
Okay, it might be backwards, but so let's say that somebody has 30,000. Is that backwards?
Nope, 30,000. I can see
Okay.
it. Yep.
So, and then to get 5%, we go times 1.05, and that's the first year, right?
Yes.
So let's just go out 10 years. So 2, 3, 4, 5, 6, 7, 8, 9, 10. Most people would never believe me that having 30,000 that you never add another dime to at 5% interest that compounds, not simple interest, compounds, they would be up $18,000 10 years from now. Unless we run the math, because we're like, okay, we either live or die by the ups and downs of the market, or we take next to nothing interest at the bank.
A lot of people are going to look at this and they're going to say, this sounds too good to be true. We're talking about tax-free money. We're talking about 5 to 6% interest, or as I read in your book, 0 to 6%, depending on the way the financial markets are, but you never lose. They have never lost any money to any of the clients in 100 years that a lot of these insurance companies have been in. I guess, how does someone get involved with a program like this? How much would they have to essentially put in monthly, quarterly,
Yeah. So everybody that's listening to this is in a different time in their life, a different income. So, but I would say just a general rule of thumb is take your age and times it by 10. So for example, if I'm 35 years old, I should probably be able to save at least $350 a month, right?
Okay.
If I'm 50 years old, I'm into my career, I should be able to save $500 a month, right? If not, you're probably off track with your goals, your retirement goals, right?
True.
So, but I've the smallest one I ever did was $100 a month, and it takes a little bit longer.
How much was that amount?
$100 a month.
So I can do any amount?
You can do any amount. Typically, you want to be at least $100 a month.
At least $100. Okay.
Yeah. So I would say that at the minimum. My highest client does $250,000 a year. Now, I would like to have that kind of money, but he does.
I don't get excited because I've never seen $250,000. So, it's like you look at your, cash.
Yeah.
I've seen it in other people's bank accounts.
Yeah.
I have a couple of friends who are millionaires, and they want me to help them with their finances, and I'm like, maybe I need help from you.
Well, there are people that are really good at earning money.
Yeah.
And they may be terrible at growing money.
Ah.
So like my father-in-law is very, very good. He's a filmmaker. He does very well for himself. He doesn't know where to go to grow his money. But it's not because he's not intelligent. He's very intelligent. He's so focused on how do I make the next dollar that he doesn't really care how a dollar grows because he can just make it faster than he can grow it. But you have to set aside money and allow it to get compound interest over time, or else you're not going to have the kind of money that you need to be able to retire down the road.
That makes a lot of sense. I wonder though, is there a catch, or is there any way I could lose money? A lot of times when we sign up for accounts, right? So I got some paperwork here. I don't know. And you have to really, like, I'll just flash this really quickly. Like all this, no one's reading all of this. Like most Americans, even with instructions for household appliances, we're like, okay, I guess you plug it up and you turn it on. And with, certain guidelines and policies, people just like, okay, just tell me what it says because I don't want to read all of that.
Exactly.
Now with this, are there any catches, or is there any possibility that you know of that a potential client can lose money?
So in the first couple of years, you don't have a dollar for every dollar you put in.
Okay.
And the reason being is there is life insurance cost involved, right? If I could get rid of the life insurance and have all the tax-free benefits and living benefits, I would 100% do it. But this is a government-approved program for people to grow their money tax-free. So, but it has to be done under the umbrella of a life insurance plan, right? So the only way I could see that somebody might lose money is if they start a plan and they want to exit early. They would take a loss because the insurance company covered them. If they had died, their family would have made out like bandits. But if they are still alive and they decide this isn't for me and they walk away, there could be a small loss. It's not going to be a total loss, right? So
Okay.
I'll give you an example. Well, let me just look at this. So like I'm looking at a plan, $300 a month. If somebody puts money in for 5 years, they've put 18,000 in. If they walk away at that point, they would walk with $16,037. So they're going to lose like $1,900. But if they had died during that time, their family would have made $200,000, right?
Oh, wow.
So there is some insurance cost there.
Okay.
Most of the
But
plans,
that's in the first couple of years you're referring to.
that's in the first couple of years. After that, unless you mismanage the money and take it out too quickly, or you borrow money and then lose it in the real world, that could generate a loss. That's not on the insurance company, that's on the user. But there's not a lot of risk to these. They're pretty straightforward. That's one thing I like about them is they give you a pretty good idea of how much money you'll have 10, 20, 30, 40 years from now, which most people can't say that, right? Like if I was to have $100,000 right now and say, how much money am I going to have at age 65 if I'm in the stock market? I have no idea, right?
Yeah,
Uh,
it's all an estimation. I mean,
in
if the
early
market grows at
September,
this particular point, at this
yeah,
percentage, then you
I
have
mean,
that.
you can run out averages and different things, but on in late September 2007, everyone thought they were rich, and then the market dropped by 777 points in one day,
Mm-hmm.
and all of a sudden, over the next little while, the market dropped 52%.
And the market, the Dow, since this coronavirus outbreak and scare, has lost 2,000 points.
Yeah,
Yeah, so
for a disease, right? I remember.
yeah,
Let's see. This was back when President Obama was in. But there was someone had hacked the White House Twitter account and said that there was an attack. Right?
yes,
The stock market dropped by over $100 billion in like 50 seconds. And then they were like, oh no, hey, someone hacked our account, and it went back up, right?
yeah.
Same thing happened when Japan had that horrible typhoon. The stock market, like 5,000 miles away, dropped.
Yeah,
So we live in a global economy now.
we do.
With this, you're guaranteed not to lose the money. And that's one thing I like about it is it's more like a set of stairs where it's like, okay, I go up, I go up, I go up, I go up.
How much money? Okay, take for instance, I have $50,000 inside of my account.
Okay.
How much of that 50,000 can I borrow? Is there a cap? Is there like, oh, you can only borrow, sir, the most 50% of the amount you have in your account?
It's usually between 90 and 95%. It just
Wow,
depends.
you can borrow that much money.
Yeah, the reason that they make you leave a little bit of a buffer is just in case you can't pay it back. You've got enough there in equity to cover for 3 to 5 years of death benefit.
And
right?
they will still be paying the interest. So essentially they can actually feed off the interest that they was given back to themselves to pay for the amount that you took out.
Exactly. Like I'll give you an example. The first plan that I've had for 13 or 14 years now, this last year it grew by $4,500. My very bare minimum to keep the plan alive was $1,300. So if I do the math, if I never touch that money, this thing could never go away. because it will always continue to compound and earn higher than the cost, right?
Exactly.
But with the plans that I build for people, if you only want to pay in for 10 years, then we have this baby paid off in 10 years. And then it will just grow organically the rest of your life. If you want to do till age
Wow.
65, we tell them, reduce paid up. We want this thing paid off. No more money's going into it. They shut down that increase or that demand for premium each month or each year. And now it's just going to grow. And the other thing that is really interesting is most people that I talk to, like I said, they're either like a really wealthy physician or business owner, or they're like a millennial like me, right? They're in there anywhere from
You're a
age.
millennial?
I'm what's called a leading millennial.
A leading
and,
millennial.
and then there's a trailing millennial.
What's
So
the age bracket for that? I'm just curious.
It's right around the early 80s.
Okay.
Yeah.
Okay.
So I was born in 82. So I'm an older millennial, almost a Generation X, right?
I'm Generation X.
Okay. So yep. So I forgot where I was going with that now. Okay. I remember.
Okay.
Is I'll take somebody and let's say that they're age 35, right?
Okay.
And I go, okay, how, you came from a middle or lower middle class family. Your parents probably didn't have a lot of money like mine. Um, the tapes that were recorded in your mind is, I'm probably not going to have a lot of money, right?
True.
And I can show them a system where if they'll put a couple $100s away every single month for themselves and allow it to compound and not have taxes eating into that, and by the time they get to retirement, they have $400,000. I mean, I've had people go, wow, I never in my whole life thought I would see that kind of money. Or I take someone in their 40s that can save $800 a month, and by age 70, we get them to $1 million tax-free.
Wow.
And they go, never in my life did I think I'd be a millionaire. And I say, you're not a millionaire. You're a tax-free millionaire, right?
I got you.
That's a big deal.
So
because
here's
go ahead.
So earlier I asked you before we came live, is that can you roll over your 401k and your IRA inside of this account? And if I can, right, and I'm saying me because I'm talking about me right now, will there be a tax? It probably will on the government side. It probably will be, but is that possible? Can you roll over your 401k and IRA inside of this account, and the government not just think that you took the money out to be penalized? Because they take a certain amount out prior to you being 59 and a half.
Yeah. So in the second strategy in Taming Wall Street, you can do an apples to apples roll from an IRA or a 401k over into that program. In the one that you and I are talking, the one that I do with most of my people, that one you can't. You could take money out before 59 and a half. I usually don't go that route with people. The reason being is you're going to have to pay a 10% penalty, and you're going to have to pay tax. And so what most people do is they just say, I'm going to stop contributing to my 401k, or I'm not going to contribute above the match. Because beyond the match, all you're really doing is setting yourself up for a large tax bill down the road.
That's what I was about to say.
Yeah. And unfortunately, I've had to deal with ripping that Band-Aid off with people. Like I'll tell you a quick story. I had a gentleman from Boston. He called me. He said, I found your book in the back of a Catholic church in a donation box. I donated it to myself. So basically he took it and he read through it, and he's like, man, I really love what I'm reading. I've got $1 million in my 401k. And I was like, oh, wow, congratulations. I don't run into too many millionaires in their 401k. And he goes, man, I'm a millionaire. And I was like, man, I'm really proud of you. I said, but you do realize you're not really a millionaire. And he goes, what do you mean I'm not a millionaire? And I go, you've never paid taxes on a dime of that money. So you probably owe about $400,000 to Uncle Sam. I'm telling you, Ray, ripping that Band-Aid off.
Why did you tell him that? You broke all his hopes and dreams.
I lost him as a client. I'll be honest with you. But you know what? You
But
know
you
what he
told him the
said to me?
truth.
I told him the truth, and he said to me, I'm originally from New York. I moved here. So I've moved 2 jobs. I've rolled money over with my HR twice, and then I retire. And you're the first one to tell me I still owe taxes on that money. And I'm like, well, I'm sure it was in the paperwork, but I said, when have you ever heard of the United States government not wanting to get a piece of the pie?
Exactly. They
They
even
tax you
want
on
money.
everything.
I even have to, when I file my taxes here, they even want you to report interest that you earn on a basic savings account.
Yes.
You report everything because they have, a ratio or a set of numbers that say, well, if you have a savings account or for any account, investments account, that if you make a certain amount of money, we want some of that money you made because you wouldn't have made that money if you wasn't in the U.S. You wouldn't have made that
Yes.
money if you wasn't
Yeah.
in this country.
Yeah. So, I'm just being honest. He did not like that, but I told him the reason I'm telling you this is because if you die, you may end up owing 60% of that money. So you're going to leave your family with a huge ticking time bomb that has all this tax that has to be paid. And once you die, that thing needs to be liquidated within 9 months. So you just have to be very careful dying with 401k money. It used to be that you could do what's called a stretch IRA, and you could stretch it over the next generation. That went away. The Secure Act that was signed by the president, that went away. And so with my older clientele that are beyond 59 and a half, I show them, okay, how much of this money are you going to really need? Let's say they have $500,000. Oh, I don't know. I don't know that I'll need much of it. Okay. Well, what if we just took a portion of that and over the next 10 years, we matriculate that over into a plan? I guarantee after 10 years, you'll have more tax-free death benefit than you would have grown your money by. And when you get there, you've got a pool of money that you can use for cars or real estate or just supplementing your retirement that you never have to pay taxes on. And people are moving money like crazy because they're realizing I can take a small tax bite now and stick it over into something that's leveraged that will never be taxed again. So that's something.
Yeah, that's actually, it generates a lot of wealth. And of course, everything takes time in any sort of program, even in investing, but the risk is a lot higher than the program you're speaking of. But we talked about some of the living benefits of this plan. What if you could bulletize some of the benefits? What would the top 3 be of this particular plan?
Top 3 is money that grows every single year, regardless of the economy.
Okay.
Never lose money when the stock market drops, and never pay taxes on that money ever again.
Now, these are the exact same thing I read in your book. Very short and sweet. I love the fact that the book is very short and sweet. I read it in
that was on
days?
purpose. I read Tony Robbins' 8-point font 600-page book. It took me like a year, and I was nearly blind. I said, you know what people need? They need real stories, real examples, and the math. And I don't need all the fluff.
Yeah, I read his Unshakable book. That was a really good book. I learned a lot about index.
Much shorter.
Now, in this particular, it's called Permanent Life, correct?
Permanent life insurance, correct.
Permanent life insurance. Now, this doesn't replace retirement accounts, do it? Or does it replace emergency funds? Like, what could I use this in lieu of? Because take, for instance, right? I always tell people you want 3 to 6 months of all your expenses in a savings account, that if something will go haywire in your life, okay, you go through a midlife or a late life crisis, you can go on that money and essentially still live off that money. Or I would say a good amount is $10,000. Okay. So does this plan add to, take away, or a replacement of?
It could certainly replace an emergency fund, but not immediately. because
Okay.
it does take a couple of years to build up. But so, for example, the plan I have that I've had for 13, 14 years, I'm way past break even. It's got plenty of money in there. I don't need money sitting at the bank earning 0.1% that I might use for an emergency. I have that inside of my plan earning 5 to 6%, and I most likely won't have an emergency, right? The other thing is, if something comes up, I can just pay for it very quickly on my credit card. That's 27% interest, right? And then I just borrow the money from the insurance company within 30 days. I pay that off. In fact, this is how I do everything. I buy everything on a Gap and Old Navy Visa. I get all those points. I pay them off. If I ever have something big come up, like I had a real estate repair come up that was a bit too big for me, I just borrowed that money. I paid it off. I got the points, but then I just paid myself back at a much smaller interest rate and at my own pace, right? But that's been beautiful. I mean, we should do a video on that because my neighbors have these Sky Mile plans, but they have to spend like 50 grand to get a free airline ticket. And
It's really not advantageous. I've been telling people the secrets of using your credit card but paying it all. Like me, I'll put $3,000-$4,000 on my credit card, knowing that before the billing cycle occurs, I'm going to pay it off, and you will gain points. But you're absolutely correct. I mean, it takes thousands, if not tens of thousands of dollars to get the amount of points that you need to actually use it for a free flight or upgrade to first class. It's astronomical.
So last year I paid $0 in interest to Visa, and I got $1,700 in gift cards to Old Navy.
Wow.
So because I've got 3 kids that outgrow their clothes like every 6 months.
Now I have a Gap card too.
Okay.
I recently just got one. I noticed that for some reason, they're the only khaki pants that I can buy that fits me in the Gap or Old Navy. They're the same company. I didn't even know that. I didn't know they were the same company. But I never really thought about using the card the way that you're using it. I use my Capital One card because it's a travel card, and I do some bit of traveling here and there to get those points. But again, it's thousands of dollars you will have to spend in order to really reap from those rewards.
Yeah, I'll tell you, if I didn't have 3 kids, I wouldn't have this Old Navy Gap card, right? I can afford that, but when you're trying to clothe 3 kids and uniforms and it gets expensive.
I can only imagine. Now, with your book, Taming Wall Street, how can I get a copy of it? How can the viewers get a copy of your book? How much is going to cost them? All the particulars with that.
So it's available on Amazon. I'm not looking to gouge anybody. I've negotiated with them. I think the book is $4 or $5.
Okay.
If they have Prime, it's free shipping. It'll be there in a couple of days. I know you and I talked before this interview, and the publisher has given me 20 copies.
20 copies
of Taming Wall Street.
Nice.
And so
can we see it from the sideways? Because some people want to know how many pages it is.
Yeah, it's
not a big book.
It's skinny. And,
it's not a big book.
Yeah, and I mean, there's even like a lot of it is just like graphs that show the math. That's the thing I like about math. You can't lie with math.
You can't lie with math.
Yeah, and so, but I can't afford to give everybody listening to this because you've got such a great channel. 7,000 subscribers. You're a superstar on YouTube.
I'm so small, Steve. I'm so small.
Well, but if they'll go to that link, yourbridgeplan.com/Ross-world, and you can put it in the video.
I'll put in the description of this video.
Yeah, I'll give 20 copies, and I'll even cover the shipping. So it's a total risk-free. They can go through, read that for themselves. If it makes sense, I'd love to help them. And if it doesn't, you're not going to hear from me again, right?
So the link that you sent me, I can post that, and that would take them to request a free copy of the book.
They click that, it's going to go. It's not even a picture of me. It's your handsome face right there, and then they just have to tell me where to mail the book. And
nice.
My assistant.
You get an actual hard copy.
if they want a digital copy, they just need to let me know. But yeah, I'm going to physically mail them a book.
Nice.
I'm old school. I like to highlight, dog ear the pages, really sit with a concept. But
I'm kind of like in between new school and old school. I'm a little bit older than you by about 4 years actually. But for some reason, I love the fact I could be somewhere and I can go right to a book. So I'm digital. I have a Kindle. I actually, read a lot off my phone, believe it or not.
Yeah.
And your book was the last book I read. So if I pop it up, it's right there.
Boom.
Right there. So
well, thank you for that.
It's a quote that was in your book. It said, taxes will be the single biggest factor to separate you from your retirement dreams.
Yeah.
Best-selling author and tax advisor, Ed Slott.
Ed Slott's the most famous CPA in America. And so think about this. When you get to retirement, you're going to have you're going to have a dichotomy of issues, right?
Yes.
The first one is, I want to be super rich
Always.
in retirement, right? Well, to be super rich, you're going to have to pay a lot of taxes, right?
Yes.
Or you go, I don't want to pay a lot of taxes, so I'm going to live poor and small. Well, why not be in between where you have a big chunk of money, but the IRS has blessed and approved growing money inside of this plan, and it's never taxed?
Oh, one key thing you said in your book, and I think everybody should know this, is that year after year, people in Congress, people in the House, they know that a lot of millionaires and billionaires are growing their money in these tax-free insurance accounts, and they're trying to pass some sort of legislation, some sort of law, sort of bill to stop it. So it's imperative the quicker you get inside one of these programs so you can actually be grandfathered in, correctly?
Yes, yeah, they are trying to get rid of the tax advantages because, again, Uncle Sam. I mean, we're $22 trillion in debt. The only way the government makes money is taxing its citizens. That's us, right? Like you and I, they don't see Ray, they don't see Steven. They see a future tax ability to siphon money off of us.
Definitely.
And they tax us to death. I mean, it's just crazy. The founding fathers split from England over 2% tax.
Yep.
And now the highest tax bracket right now is 39%. Oh, is it 37? Okay.
Wait a minute. Maybe
it's high 30s.
High 30s, yes. High 30s.
Yeah. But what most people don't realize, and you can search this, I didn't put this in my book, but after World War II, did you know that the top tax bracket was 94%?
How is that even possible?
They had to pay for the war. So
37%. I was right. 37% the highest tax bracket.
37%. But yeah, if you search historical tax rates after World War II, it was over 90%. It's crazy.
That's almost a socialist society.
Yeah.
That's why you're probably voting for Bernie Sanders, right? No, I'm kidding. I'm kidding. That's personal information. I'm kidding.
So, but listen, maybe we wrap it up with this one last question. If you could wake up with $1 million in your bank account on your first day of retirement, do you want to still owe taxes on that money or be completely tax-free on that money? Right?
Totally tax-free.
Everybody's going to say that, but then they're going to keep saving inside of a 401k or an IRA that must be taxed. It's not a matter of if, it's a matter of
must. And they're going
to
keep investing in the stock market with large proportions of money rather than put 25% inside of a permanent life insurance plan.
Exactly. And I'm not saying this is where you put all of your money, right? It's not where I put all of my money, but it is the first place that I put my money, and then I invest out of my accounts. But I don't expect everyone to have that same buy-in. But we know that you're going to be taxed in the future, and we know that you're going to die in the future. And if you can eliminate the burden, the heavy, heavy burden that comes from those two things, I just think it makes sense. And the plans that I build, they're the best plans out there. I've never had anybody build a better plan than me. And that's because I'm willing to take that huge hit in pay to give people the best plan. And the byproduct of that is I get more referrals, And I take care of the people that way. So anyway, get the book, take advantage of this opportunity. And if it makes sense, I'll run numbers for people. I'm a no pressure guy, and I'm happy to introduce you to people like yourself that are already in the program. And you can call them privately and say, hey, what's it like to really work with this guy? How do you really like your plan? And they'll give you an honest opinion. So
I appreciate that. And by the way, to confirm what you're saying, in 1944, 1945, the tax rate was 94%.
oh gosh, yeah. I,
Yeah.
I can't even imagine. Like, imagine you earn $100 and you get to keep 6 of that.
$6.
It's
I
crazy,
don't even
right?
know how you survive.
I don't know how they did either. And so, but 30% tax is still really burdensome,
Yes.
it's high. So anyway, if somebody, has money, even $100 or more, and they want to protect their family, they want to grow that money every single year, they want to be their own source of capital down the road, and legally avoid taxes. I think this is a good way to go. It's at least worth investigating.
Now, if I wanted to get in touch with you, if I was a potential client, I want to get involved with this permanent life insurance to safeguard my money, to not pay taxes, to grow my money anywhere from 5 to 6%. And if I were to take out of a loan, I would be paying myself back with interest. How do I get in touch with you so I can start this plan?
So the best place is probably to go to my website, yourbridgeplan.com.
Okay.
They could email me, Stephen with a PH. So
Okay.
STEPHEN at yourbridgeplan.com. And then I'm fairly busy with my speaking schedule, and I've got another book in the works right now. But if somebody comes to me and they're willing to learn, I will always take time to work with them. I've made that commitment. A few years ago, I had somebody say to me, the level of success you're at, you shouldn't work with people that have less than $500,000 in assets. And, I sat with that for a week because I would make a lot more money doing that. But it dawned on me, I wouldn't be able to help my own mom and dad. And
Wow.
so it just never sat well with me.
Wow.
I grew up in a family of 6. My mother was a school teacher. So we grew up lower middle class. Occasionally we needed help from grandparents to even cover Christmas. But I had a beautiful upbringing. I love my parents. They taught me a lot of good things. But now the things that I show them, their first response is always, I wish I had known this
Exactly.
earlier. You know what I mean?
Exactly.
So, yeah, it's worth looking into, and it may not be for you. Every now and then I have people that they're like, listen, this is just not for me. And I go, okay, it was really nice to meet you.
Wow. All right, I think that's our time, Stephen. Thank you for all the great information that you've given to this channel. I'm definitely going to talk to you after this because I'm actually really on the borderline of doing this. I mean, it's a no-brainer not to do it. With more information comes new opportunities to save your retirement and safeguard your money throughout the course of time. So if you don't have any other comments, I'll just close this out.
No, I would just say the last thing is one of the benefits of working with me is I will take the time to walk you through your numbers, and usually more than even reading the book, when people can see their own numbers, their own retirement deadline, and how much they'll have, that tends to help the light go on, and they go, okay, now it makes a little bit more sense. But what it really gets fun, and we didn't have time to get into this, maybe another time, is buying your own cars, real estate, hard money lending. Once you have enough capital to do those, man, this thing really sizzles.
I read a lot of that in your book, and that's why I want to remind the viewers that I'm going to have information for Stephen, his email, as well as though the link to request a free hard copy or digital copy of his book, best-selling book, Stephen Gardner, Taming Wall Street. I read the book. It's a good book. I was just kind of like,
Yeah, no, I appreciate the opportunity to be on here again. My mission is to help strengthen America one family at a time.
I love
And
that.
we can't control the U.S. economy, but with some good education and skill set, we can control our own economy.
Exactly. All
So,
right, everyone. This is Financial Literacy 101. I'm your host, Roswell, with Stephen Gardner. Learn money and be inspired. I'm out.
Thank you.